Today on John's Top 5 for today, we are in the beautiful Kaleo model home out in Southern Point. That's in South College Station. It's where the old Speedway used to be. And you need to come see not only this beautiful home, but the community it sits in. I'm here today with Adam Wells CSTX Mortgage, and we're going to be discussing the questions that should be asked of a mortgage lender. Adam, tell us a little bit about yourself and how you got into mortgage.
You bet. So I've been in mortgage lending since 2018. And before that, I was in that realm. I was as a real estate agent for a year. And then I also did some real estate investing. So I was swirling around that environment and found my way into mortgage lending.
Fantastic. How many years ago was that?
That was, I became a mortgage loan originator in 2018. So
2018.
6 years now.
It's been a while. So you've got some experience under your belt. Is there anything else that we need to know about you?
Yeah, for sure. I mean, when I'm not originating loans, I'm spending time with my family. So I've been married for 18 years.
Congratulations.
Thank you. And we've got 3 children, and we homeschool, so that keeps us quite busy.
I bet so. You know, we visited a little bit before we got started. What is the connection between interest rates and closing costs?
You bet. So I think one thing to just to let people know that interest rates aren't just hanging in thin air, right? So these are numbers that are connected in one way or another to a cost.
Okay.
So you have closing costs. Those are some third-party fees and escrow fees that go into what you're bringing into the table when we're closing.
Right.
But there are also lender fees that are specifically tied to an interest rate. So we might be able to offer an interest rate without a fee. We might be able to offer an interest rate with a credit to the buyer. So all these things are important to discuss, and we're never just presenting one number. We're always talking about interest rate when it comes to those closing costs.
So can you give me an example of when something like that would actually affect my closing costs?
Right. Good example is we're sitting here in the Kaleo model homes here in Southern Point, and I'm one of the preferred lenders. And so we can offer 1% of closing costs credited to the buyer at closing.
Okay.
So we take 1% of the loan amount and give it back to you to help you save money on closing costs. It's one of the ways that we can help. But there's also scenarios. I was actually having this discussion with a young man this past Saturday, and we also showed him the option of what if we use that 1% that we're giving to him rather than a closing cost to help buy down the interest rate.
Okay.
So again, we have this idea of rate and cost. Those two numbers go together somehow. So basically, when it comes to lending, you're going to be paying now. So you're paying some upfront costs to get a better rate for the long term, or you pay more for your interest rate over time. And we can help explain why one of those two options would be better for you depending on your situation.
Question number 2. What strategies can I employ to save money on my interest over the life of my loan?
You bet. So the easiest way to do that is by paying down your principal balance. And that can be done with a monthly payment, quarterly payment, yearly. It's totally up to you. One example that I can think of in my own life is that I've got a mortgage. And initially, when I bought my house, interest rates were very low. And I thought that would just be how the interest rate environment would be.
Right.
Obviously, that's not the case, right? Things have changed dramatically. So right now, I'm not paying anything extra on my principal because I know that I'm getting a better return on my money in other places. So if you've got an interest rate in the 2s and 3s, you probably don't need to worry all that much.
Right.
Especially if your plan is to use that house to create a rental property for you in the future. So
if I'm keeping it long term and I already have a low interest rate, you're paying it down faster may not be the financial move that I should take.
May not be. Yeah. So I would do a calculation with you to figure out, first of all, we start with what's the goal? Why are we doing this? And then we can make those calculations to show you what's a better return on investment. If you're in the 5s and 6s, and certainly if you're in the 7s, you have to have a strategy because we don't really know when rates are going to come down. So we can come up with something, even though the higher rates means the higher monthly payment. We can figure out a plan that's going to work for everybody to help them save money over time. Another way that will help people is once rates do come down and we are in a situation to refinance people to give them some savings, they can simply keep their monthly payment exactly the same and apply those funds to principal pay down. So we can show you exactly how that would work.
Thank you. Question number 3. What is the impact of a larger down payment on my monthly payment?
So in my opinion, it's not that big of a deal. So oftentimes people are set on this number of 20% down.
Right.
That's very difficult, especially for first-time home buyers.
Especially with the prices of homes going up considerably. Yes.
For sure.
Yeah.
And even for people that are, they're cashing in on some of their equity, they're going to sell their house and buy another home. 20% down isn't necessarily the magic number.
Okay.
So
is there a magic number?
My magic number is the least amount of cash possible.
Okay. All right.
And there's, everyone is going to have a different opinion, but I think there's a value to have money set aside. So if you are like most people, you've probably gotten into a house and then you realize some of those expenses were maybe even more than what you thought initially. Okay. So what tends to happen is that people do end up going into some additional debt beyond their mortgage once they buy their first home.
Right.
And so that can be difficult to deal with. And so if there's credit cards that have piled up and you're getting ready to sell your home because you've got equity and you're moving into another home, you're probably better off taking that money and paying down those high interest credit cards than you are carrying that debt in with you into a new home. So I like to see people debt free other than their mortgage.
Sure.
Because I think mortgage is really leverage. And so once you understand that the money that you're borrowing can be a very small fraction of what you actually need to make the purchase, then that makes it more attainable, but it also gives you really a much better return on your investment. So when I bought my house, I put down the minimum required down payment. I had more money available, but I understood that I'm leveraging someone else's money.
Right.
And so my little 5% down payment has turned into over $100,000 in equity. So if you think about it from an investment standpoint, you want to know, what is this cash going to do for me?
Right.
Not just put down 20% because that's what my neighbor did.
Exactly. Question number 4, how can I move my home from being my personal home to a rental property? Is there some magic formula to making that happen, or is it pretty straightforward?
It's probably easier than you think. So if you bought your house in 2020, I can almost guarantee you that we can turn that house into a cash flowing rental property and still give you enough money from the equity of your house to buy your next home. So if you're feeling a little bit cramped, maybe that first home that you bought is, has served its purpose, and now it's time for you to move up. You're probably sitting on enough equity to tap some of that equity in a home equity line of credit without disturbing the mortgage at 2 or 3% that you have right now.
So I don't lose my wonderful interest rate that I'm so proud of, but I'm able to pull the equity out and buy the next house that I've been longing for.
That's right. Yeah. So I did a calculation with a young man this past weekend, and we figured that we could have him qualify for the purchase of a new home. It's actually being built by Kaleo Homes.
Wonderful.
And he has enough equity and his monthly payment is low enough that he could put a renter into that house. Even with the additional cost of a home equity line of credit, he could still wind up cash flow positive, have enough money to exit that property and turn it into a cash flowing rental property for him. So some of my experiences, of course, in that investment world, and most people are thinking more like, I need to put a house, I need to put a roof over my head, I need a place for my family to live. And those are all good things, but a home is an incredible avenue for wealth generation, and the mortgage, believe it or not, is actually part of that story.
Well, sure it is. Question number 5. How can I get more house by changing my spending habits?
Well, I'm glad you asked that.
Isn't that the magic question? Yes.
Taking a step back, I get to see everyone's bank statements that I work with. Right? So you can't really hide anything from me if you're giving me your bank statement. I can see,
your spending habits,
where you're spending your money. Right?
And as a mortgage lender, that's normal.
Right.
Okay.
Yes.
that's not
fine.
That's right. That's normal.
Yeah. So we take a look primarily because the government requires us to prove that there's no illicit funds getting into this transaction, but it does help us in analyzing people's budgets.
Sure.
So I did meet. I guess this was back in 2022. I sat down with a client and they were paying $1,300 a month for rent. And they really didn't want to go much beyond that. And then we finally talked them into $1,600 a month. They thought that was a safe number for them. And then I went back and looked over their bank statements, and both the husband and wife work outside the home. Both the husband and wife ate out for every single lunch
meal.
So that's 2 times 20 times 10. So it's
considerable.
It can be upwards of $1,000 a month that they're spending without them even really realizing that this was just a normal thing for them.
Right.
So we took $600 of that, added to their budget. Now they're at a $2,200 a month payment.
Okay.
And this is where it gets really cool. So if you look at what they could have bought on their rental budget, $1,300 a month, they're looking at maybe $150,000 home.
Right.
Nothing wrong with $150,000.
No, not at all.
If you look at the way that appreciated versus the house that they actually bought, we're talking about $140,000 over 5 years in equity differential.
Wow.
So the home A that they could have bought on their budget is worth $200,000. Their house that they actually bought in 5 years will be worth somewhere around $330,000. So
that is fantastic.
A huge difference in what that equity growth looks like over time. So, always be careful with your budget.
Sure.
I'm not saying go crazy, but there is a significant difference in what you get, and then really the long-term outcome of that equity is a really interesting story.
What you're telling me is that taking my lunch to work can not only save me thousands, but actually make me thousands. Hundreds of thousands over time in the home that I could have bought.
That's right.
Okay. All right. I have a last question, kind of a bonus question. Is if I were an investor and I'm out here and I'm watching this video, one of the questions that I am asked is, should I pay cash or should I get a loan on this rental property, investment property that I am about to buy?
Well, I'm going to give you a very lendery answer. It depends.
Of course.
Right. I would say that there are 2 main strategies when you're acquiring a rental property.
Right.
And you're trying to make money, right? At the end of the day, this is an investment for you and your family. And there's 2 primary focuses that you can have, or maybe a combination of the 2. But investor A is looking at cash flow. They want to see how much free money they can bring into their bank account every month. So that's the difference between their cost on that monthly housing obligation versus what they can receive in rents.
Okay.
So that's how they're going to measure the attractiveness, or does it fit their box? Is it a cash flow property?
Right.
Another investor is looking primarily at equity growth over time. So this is somebody that wants a mortgage and is going to leverage other people's capital to help them capture equity as property values continue to improve.
So it really does depend.
It does.
Depends on, like you said, with just about everybody, finding out the long-term goal. Yes. What is the actual need that's underlying, whether you're a family or an investor?
That's right. Yeah. And this is really where it comes down to, what makes the difference between a mortgage professional and someone that can quote you an interest rate from the internet.
Right.
And that's somebody that, if you're a hammer, everything looks like a nail.
Yeah, I've heard that more than once.
Right. So from my perspective, what we're trying to do is figure out what your long-term goals are. And for some people, it's just, let's do what we can to just get you in that house, right? The strategy is to get in the game, right, in the real estate game. But for some people, we have many different options, and we want to make sure that we understand those and present those to you clearly. Okay.
Thank you so much for the time. I look forward to working with you in the future. I know that there are people out there wanting to get in touch with you.
My number is 915-780-3599. That's El Paso phone number.
It is an El Paso number, but they'll get College Station.
That's right, I'm here.
Yeah, CSTX Mortgage right here in Bryan College Station. My name's John Byers. Thanks so much for watching. We'll see you next time.